So stock trading, there are two main types of stock trading: long term and short term. Short term are things like swing trades, day trades, and etc. Okay, and long term are stock trades where you purchase a stock, you hold it for a year or so, maybe longer, or maybe even shorter, and then you sell. Okay, but then you know, okay, so there are two types. Then after that, you have so once you decide on which type of trading you want to do, you need to learn that particular style and then you need to master it. I wouldn't recommend you doing short trading without studying a lot more, and because it's very technical, very technical. There's a lot to learn about it. Okay, and short trading, short-term trades where you make money within days, weeks, months, basically quick flip over. Basically, if you're successful, if you're not, you're going to lose all of it more or less at once, or bulk of it, basically, right? It's very risky. If you want to do short trading, you can download 212 and then you can play with the demo app where you can actually play with like £50,000. The app will give you not real money, it's just a pretend money, and you are going to trade with it, okay, within the app, like as if you're going to trade in real life, short trading, okay? And that's how you will master the particular concept, short trading concepts. You can look into it. There are 4 or 5 different categories, 3 main ones. But in the future, I am going to study that particular field, short trading, especially the swing trade. Right now, my focus is on long-term trade, and where I want to build up a portfolio and I hold on to it. That's my main aim and objective. So again, you need to know what you want to do with it, and once you know, you strategize according to that. So that will lead you into strategy. So then once you know what kind of trade you want to do, so for example, I want to do long-term trade. So I buy things on low, market low, ideally. So for example, I'll give you an example. Earlier today, I've been watching the Microsoft stock for a good 3 weeks. It hasn't been down at all. Today, it's down. Earlier was 5%, literally 4.8 something percent down it was. The bottom here. That's massive. That's a huge drop. To think Microsoft rarely drops. Essentially, its 2.5% gain would have been a lot higher. It would have been just over 7 or nearly 7, basically, if it wasn't for the drop. But that's the thing with stock trading. You got to be prepared for loss as well. I wouldn't. Another thing is that don't put more money than you can afford to lose. So if you lost £1,000, is that will you sleep over it? If you are gonna lose sleep over it, then do not put £1,000 in stock trading. Okay, it is risky, but if you are not going to lose a sleep over it, then you might want to put that money in. So it's really important for you to know your risk threshold, how your tolerance, what's your level of risk, and what's your threshold. Okay. The saying, like, you play hard, you get, you work hard, you play hard, or you have to spend money to make money. I don't believe in those things, but it is a risk, but you make calculated risks by studying the stock trade and stock market. So earlier I purchased Microsoft stock at 3.3% down, basically, and I was very happy with that. But it's if I use different graphs, I could have predicted it, and I purchased it basically here. That's where the line is. However, it kept going down to nearly 5%. I have another thing is you have to discipline yourself. So I limit myself to, £1,000 a day, and once I reach that, I stop, basically. Okay, otherwise you're going to blow your money and you're going to become addicted to this potentially. But you have to make calculated decisions. So with my long-term strategy, I waited. I never bought anything on Microsoft, purely because up until now, the stock was very high, as you can tell. So we are here. Now it's just gone up. Oh, see, it's 5. No, it's last week overall down. So it was the whole week. It was up here somewhere, very, very high, right? No, I don't want to sell. Very high. So I never purchased anything. I thought that's way too high for me to buy. I won't purchase it for the sake of it. Even though it's long term, I'll wait and hold. And when it dropped, I was willing to purchase, because for me that was a good gain. I can afford to purchase at that price, hold, and then it will hopefully pay off. It does pay off. Okay, so because of my long-term strategy, I'm not worried about it. If it is down tomorrow, it might be down. I'm not worried about that. I won't be worried even if it stays down for a while. If it stays down more, I will purchase more stocks. So it's at the moment nearly 4%. If I didn't max out my daily capital, I would have put more money into this particular stock, because I really believe that Microsoft is going to dominate the next decade because of AI that they own, and their AI is going to be supreme. For that reason, I would have bought more, but I'm not going to. And also, Microsoft generally is a safe stock. So another thing you want to ask yourself is what sort of stocks you want to trade in. So for example, obviously by now, you would have realized, okay, what kind of stocks you want to trade in, short or long, meaning long term. And then you decide, obviously you'll have to find the halal stocks. So once you find the halal stocks, you then will have to decide, do you want to play with, and then you have to decide on which sector you want to focus on. Now, the reason why you should focus on at least 3 or 4 different sectors from the stock market, so that just in case if one sector is in really bad, the other sector is going to keep you afloat or make you money or profit, right? If you put all your money in one basket or one sector, if that sector goes down, you're going to lose it all. That's why you spread the risk factor. You spread your risk across the board by focusing on different stock sectors. As well as that, within each category or sector of the stock, you have different types of stocks. So you can focus on that. So for example, this is tech, right? And within IT sector, so not IT, within IT sector, Microsoft is a blue chip, meaning it's a safe, strong, dominant stock to put your money in when it's down like this. Now, in that process, you can see its market cap. Market cap gives a huge understanding of its power, essentially. Its dividend yield, that's how much profit you'll make, which is not very good, but it will grow quite rapidly. Look at the beta rating, which is below 1, which is fantastic. That's almost better than some of the stock market and ETFs themselves, actually. PE ratio is quite high, but that's okay. It's a very, very strong, safe blue chip company. Here is 1 year graph. Look where it is. So as you can see, this is a particular stock that will constantly grow, okay? And where we are now, it's almost at the peak time, basically, right? Leveling the peak. But it is expected to go beyond that. Not now, probably in next year or so, or the years coming. So it's worth investing in this particular stock if you want to hold on to it. So within 1 year, it gained 33.79%. What that means is that's last year. So if you bought a year ago, one share of Microsoft, which would have been about 280 something like that. I'm just guessing from the top of my head. And if you sold it now, you would have made almost £100 profit, basically. So it's giving you a total you would have sold it for £84.89 profit. Okay, so that's 33% plus gain. That's what it's telling you. If I purchased the Microsoft stock 3 months back, I would have made 14% profit on it. Right now, even though it's down, I still would have made 14% profit, basically, yeah? So hopefully that gives an idea as to insight into the stock market a little bit. Now, these are candle charts. Talk about another video and maybe you can look into a bit more. But yeah, stock market is very easy, very simple, straightforward. Don't see as a threat don't fret basically over it. And it's not frightening. It's actually quite an easy concept. Now, if you don't want to go into things like analysis and all that stuff, right, you can then focus on just safe stocks, stocks that are steady, so very strong, generally speaking. Stocks like Eli Lilly and Co, for example. This is a safe stock, generally speaking. Why? If you look at its trajectory, can you see? It's look at its growth. Not trajectory, but yeah. While its trajectory is good, but its growth, as you can see, is quite steady and constantly growing. So it's a safe stock to invest in for the long term, for a couple of years and longer. Even that is a good stock. This is a mining company, I believe. But actually, it's a bit of a volatile one, but it's still relatively safe. Other good one is Coca-Cola. So if you want to put a lot of money in this, you can just put your money in there and watch it grow. As you can see, and likewise, so is Cisco. Another IT. I don't know why Cisco's down today. It's a bit volatile, but it's still safe stock to invest in. And just bear in mind that this is another good one. Bear in mind that when your stocks go down, don't panic, because that's just the nature of stock market. It goes up and down. And if you didn't do that, then it would just be fake money, basically. But because they go up and down, you have to make decisions based on, your knowledge and things. But don't panic. Main thing is don't panic. Hold. And then hopefully things will get better, which it does, as you can see, right? So if you bought it here, people would have panicked. And selling here, unless if you bought it here, for example, and you sold it here, you would have made loss. So what you want to do, unless you bought it here and you sold it here, you would make profit. But when it goes down, hold, be patient. It goes up again. It goes down, but it goes up. It always does this, stock market. So it's important to understand that it's always going to go up and down. And if you didn't do that, then, what kind of thing are we investing in, basically, right? And that's what makes it really exciting. But you also got to understand why has it gone down. So here it would have gone down because of the pandemic, 2019, COVID. Here it would have gone down because of economy. After that, it recovered, as you can see here. But then it went down quickly because of the economy. Here it went down because of inflation. So the war, essentially. So you can see, you can understand when you look at the graph, you can actually understand what's going on and why it's down. Is really important to understand that, because those things impact the stock market movement, price going up and down. Same with, for example, property market. Like property market is down at the moment because of inflation in the UK. But then if you look at this company, Barratt Home, it's got like this dip here is because of the pandemic. And then it went up, as you can see. And then it was kind of riding the wave. And then we were hit by the war. And then the inflation is down here, but it's rising again. It went down recently because the inflation wasn't in control, but now it's going up. So the government made an announcement regarding relaxing the legislation when it comes to property development and property renovation and stuff like that, and property development, properties in a nutshell. So then that will impact the stock, which it did. It started going up yesterday, and it went down today, but then it's still on. If you look at on its trajectory, it's still on up. So I bought shares when it was here and there, so it will keep going up. Hopefully, that's the idea. So it's really important that you also get your head around graphs and how to read graphs and understanding those things. I also like to look at this. So here, if you go on per share data, you'll get a good understanding of things like companies' growth. Like it's growing. Return on asset is about 8% over 5 years. Return on equity is about 12%. Return on investment is about 10% over 5 years. It's not very good, but then you have to understand why it's so low, and that's because of pandemic and the war and the inflation. So that's what's impacted its growth potential. Otherwise, that would be double, I would say. But on a positive note is if we go back to here, this tab, if you look at dividend yield, what is dividend con? Dividends here. So it's a regular dividend payer, as you can see, and its dividend is not bad when you think about it. 7.84%. That's annually. You'll work out annually. I think they pay about every quarterly. So yeah, you're investing money, and yeah, it might be growing. So you got to bear in mind that's a gain here. 7.84% is what I'll get from that money that I invested. But then if you look at the growth over a period of a year, it's on down. However, if you look at 1 month growth, that's 10%. So if I bought here and I sold now, for example, I would have made 10% return on investment. Again, yeah, that's so all these are part of your strategy, how you want to approach it. But I'm looking at it from more technical point of view, and I'm looking at things deep down from from a stock trader's point of view, basically, rather than simple basic stuff.